Sanibonani. Hello, everyone. My name is Sebenzile Dlamini. This topic is part 1 of access to credit. We will be covering the features of a winning proposal. This topic is necessitated by the fact that every business needs to raise capital at different phases of the business cycle. Please note that you can use the same proposal that you will develop with some modification to apply for grant or equity financing. Before I start covering the following elements, I would like to share the 4 common means of getting involved in business. The first one, which is our primary focus, is starting a business from scratch so that you can have a startup, which is an early stage innovation-led enterprise, or a small and medium enterprise. The second one is buying an existing business. The third one is investing in a franchise. The fourth one is buying shares in an existing business so that you can become a shareholder or stockholder. This session has 6 topics. The first one is preparing to learn, followed by self-funding or bootstrapping. Thereafter, we'll talk about credit overview and cover types of business after that. The last 2 topics will be preparation and documents and credit assessment. Preparing to learn. I'd like to remind you to get a pen or pencil and a notepad so that you can write some of the things that I will say which are not written in the slide. Before I start covering the different topics, I'd like to share these 2 quotes. The first one by Mahatma Gandhi says, "Capital as such is not evil. It is its wrong use that is evil. Capital in some form or other will always be needed." Richard Herold once said, "It's almost always harder to raise capital than you thought it would be, and it always takes longer. So plan for that." While this topic is about access to credit, I'd like to share with you that startups all over the world usually start the enterprises with the founder's equity. Self-funding or bootstrapping is founding and running a company using only personal finances or operating revenue. This is a good form of financing because it allows the business to maintain more control, but it can also create financial strain for the business because the founder's equity can run out at some stage, especially when the business starts to grow. At that point, the business will need external financing. The examples of self-funding that I'd like to share with you are personal savings. If you already have some form of income, you can save a portion of that income to finance your vision. If you don't, you could start a small activity that can generate sales income. For example, you could sell ice lollies or bunny chows in your community so that you can earn some sales income and use that money to create the venture. Some founders rely on sweat equity at the beginning of a business. For example, if they are focusing on a service which relies on their skills or expertise. Sweat equity relates to the reliance on efforts and physical work to create a venture from an idea. Some founders quantify this in monetary terms and record this to show their commitment to the business venture. The third one is quick inventory turnover, which relates to managing stock in such a way that it stays in the business for a very short period of time instead of staying for a long period of time, because inventory can generate losses for a business. The fourth one is pre-orders, which entails giving customers the right to order and pay for products or services before they consume them. That enables the enterprise to avoid having to raise funds to buy stock before receiving payment from the customers. And the last one is lean operations, which entails the removal or elimination of unnecessary expenses or costs in the business. For example, a startup can operate at home instead of operating in a leased facility where there will be a rent overhead on a monthly basis. Credit overview. When a business secures credit, the arrangement is governed through an agreement. Through this agreement, the lender gives a borrower the right to access and use the money and pay it back at a later date, often with interest. The agreement contains other terms and conditions for accessing the funds and servicing the debt. The terms and conditions include a repayment period, which will be specified in terms of intervals. The intervals could be monthly or quarterly. Some businesses, such as those in the agricultural sector, sometimes qualify for seasonal payments. When you repay debt, the lender expects you to repay the principal, which is the initial amount borrowed, together with an interest expense. The interest expense is a percentage of the principal or loan amount. It is the cost of the borrowed funds or the financial reward or profit for the lender. The outstanding debt becomes a liability in the company's balance sheet. I am giving you an example here. If the business borrows 5,000 emalangeni from a bank and the repayment period is 3 years or 36 months at an interest rate of 25%, the business will repay the principal of 5,000 emalangeni together with an interest expense of 2,156 emalangeni 77 cents. Every month throughout the 3 years, the business will be paying 198 emalangeni 80 cents. At the end of the period, the principal plus interest will be 7,156 emalangeni 80 cents. Credit overview. It is important to note that companies do not pay exactly the same amount of interest expense, even if they borrow the same principal amount and repay it over the same period of time, due to the following 3 reasons. The first one is the type of lender. Banks, development finance schemes, such as those owned by government and non-governmental organizations, and loan sharks charge different interest rates. Usually, development finance schemes charge the lowest interest rate, followed by banks. Please try to avoid loan sharks as much as possible. Their interest rate is usually the highest. The second one is creditworthiness. A lender assesses a borrower's potential to disregard his or her debt obligations based on a number of characteristics. So basically, the lender assesses the probability that the business will default on the loan payment. The third one is type of credit. There are 2 main categories of credit for business. The first one is cash flow solutions, and the second one is asset-based finance. So these 2 types of financing attract different levels of interest expenses. Types of business credit. In this slide, I am giving you examples of the two types of business credit. The first one, which is cash flow solutions, are offered to businesses, and the expectation is that the business will repay the principal plus interest over a period of 36 months or less. In this category, there is business working capital, which is often granted to businesses when they have a contract or a project. The second one is revolving credit loans. This is a revolving loan facility utilized to finance working capital requirements or for bridging finance pending payments from debtors. The third one is overdraft. This is a fluctuating facility. Its interest is calculated on the amount utilized, and the facility is renewable annually. The second type of business credit is asset-based finance. It is often granted to businesses for a longer period of time than the cash flow solutions. The first category of asset-based finance is commercial property loan. This is used to finance the purchase of a commercial property, for example, land or a building. The second one is vehicle and asset-based finance. This is used to purchase motor vehicle or movable equipment like machinery or computers. Preparation and documents. Every potential lender or equity financier or a grant funding institution will expect the business to present a coherent and realistic business plan. Every business is expected to keep financial records and present proper financial records. Because if you are not able to submit proper financial records, you are unlikely as a business to be trusted by those you are pitching to. Every business is expected to have a bank account and to bank, to actually deposit money in the bank. Every business is expected to have strong human capacity. It is important to start a venture that can grow and ensure that you equip the venture with good human capital. You must be willing to hire and manage people. But in most cases, at the early stages of a startup, you find that there is one founder or two founding members and freelancers or volunteers or temporary employees that are not necessarily drawing a salary from the company. But you just need to be able to demonstrate that the team composition is adequate to execute the business mission. The fifth one is managing cash, because cash is king. This can be ascertained from the cash flow statement and cash flow projections of a business. Therefore, it is important for every founder to learn how to keep financial records and to work with seasoned accountants to develop appropriate cash flow statements and cash flow projections. The sixth one is managing profitability and tracking margins against overheads. Overheads are your fixed costs, the costs that you cannot afford not to pay. For example, if you have offered employment contracts to your employees, you have to pay them salaries every month. This is assessed from the income statement or profit and loss statement. A startup that is just beginning can also present projections rather than a statement. It is important for a business to track debtors and creditors. This will be assessed from your balance sheet statement. Every business that aims to grow must be able to document all key businesses. Because if you don't document the key business processes, it is not easy to learn, to avoid waste, and create an efficient business. It is also more difficult, or it takes a longer period of time to train new employees about the critical processes of the business if they are not documented. Lastly, it is important to demonstrate good communication skills. By good communication skills, I don't mean that you have to be eloquent, but you must be able to communicate in the shortest possible time clearly. Verbally or written, you must be able to communicate the message and make it easy for other people to understand as quickly as possible. Social capital or networks is also important because when you're starting a business, you might not have the funds to hire the appropriate human capacity, but you could rely on your networks. For example, you could indicate in your business plan that you are not an expert in this subject matter and you cannot afford to hire an expert, but you have a friend or a friend of a friend who has offered to volunteer and assist the business to develop a particular product or service or manage other aspects of the business. Preparation and documents continuation. Financial institutions will expect an early stage MSME or startup to present a business plan as an application for funding. The business plan will have all of the topics that I have listed here. It is always beneficial to include an appendix which describes the key attributes of the founders or directors of the company. It is always beneficial to also attach any contracts or letters of intent that the business has secured. Please note that financial projections are a part of the business plan. The written story or narrative alone does not make the document a business plan. Everything that is written in words must then influence the financial projections. For a fully established business, financial institutions expect a business plan together with debtors and creditors' age analysis and the director's personal balance sheet. Credit assessment. Financiers conduct a test when looking at applications for credit. There are 5 C's that they normally look for. The first one is character. They look at the credit history of the business, the borrower's reputation, or track record for repaying debts. If the startup is fairly new and has never borrowed money, the financial institution will most likely look at the personal bank statement of the directors. Or they can look at how you manage your debtors and creditors. The second one is capacity. This is about the borrower's ability to repay debt. A financial institution can assess that based on the balance sheet and the profit and loss statement or projections. They also look at capital. That is the borrower's contribution towards the investment. This is the shareholder's equity, which is found in the balance sheet. They also look at collateral or security for the debt. And this is one of the reasons for the low success rate of applications for credit, which are submitted by startups to many financial institutions. The last one is conditions. These are conditions that are outside of the lender's control, plus the interest rate, the amount that is required, and the repayment period. The credit assessment or financier's test, as I have mentioned before, is influenced by information that the enterprise presents in three main financial documents. These are the income statement, which at the top will show the income or sales, followed by the costs of goods sold or cost of sales, which are the direct expenses, direct costs of producing the goods or services, then the operating expenses, and lastly, profit. The second one is the cash flow statement, which covers operating activities, financing activities, and investing activities. The last one is the balance sheet. The balance sheet will show assets. These are business resources used to run and grow the business, and liabilities, which cover what the business owes. And lastly, equity. These are the shareholders' funds invested in the business. As you have seen, it is quite important for founders of a startup to make sure that they develop the product or service, but also develop the financials for the business. Because without the financials, it is not easy to convince any other person or any other business that your business is worth financing. Thank you.